Well, look, this is the logical transformation of a company going from being a tech company to being a consumer product company that happens to have a lot of technology and it's very good. So then you're trying to figure out, well, wait a second, it's selling at 17 times next year's earnings. How do we get our arms around that versus, let's say the best of the best, which is Clorox, which I have on tonight, it sells at a much, much higher multiple. And we're just really struggling. The market's struggling with how much to pay, but it knows that it can't pay this little, given the fact that it is a consumer products company. I mean, should it get a 25 multiple like Clorox? Well, I think people would say that's fanciful because the number would be so high. But then again, when Google was at $88, I said it was too cheap, and people laughed. So, maybe we should put a 20 multiple on it. I'm not being full of myself. I am just saying I've been saying this is a consumer product story for some time, and people are starting to figure that out. And look at Clorox today on a quarter where it showed an additional % growth. It's up 7%. What do you do with a company that could have accelerated? This has accelerated service growth. Which is one of the greatest streams I've ever seen. What are the gross margins of that thing? I mean, they don't have to do anything. What a great business! It's better than Facebook, and they don't give your name away to the Russian.
Jim, I'm gonna put myself in the shoes of one of your callers tonight, and if I called in Mad Money and I said, Jimmy, I've owned this stock. First, I'd throw out a booyah, and I'd owned this stock since $70, since $75 or $100, and now it hits $1 trillion in market cap. Stocks north of $200. What should I do? Should I take profits here, or should I continue to ride this wave?
Well, wait a second. First, I want to know, is this Toni from New York? Toni?
Hey, Jim.
Is Toni there?
Toni is there.
Oh, man, you're the nicest guy. Look, the truth is that what happened is it was peak tech stock. It just wasn't a peak service stock, and that's all that really happened. It was hard to tell that it would become that it should be covered by consumer products analysts. But, when I can't violate my rules, I always say you got to play with the house's money when you have that situation. So you have to take something off the table, even though I say don't trade it, own it. But I also have another master, and the master is the discipline I've been doing for 35 years, which is that you have to take something off the table, even with the greatest stock in history.
And I would imagine, Toni, that there are a lot of investors who find themselves in the very position in which Jim and I were just discussing. The stock is, as you said, this incredible appreciation story. There are people who have ridden this wave higher and higher, seemingly unabated, of course, with some peaks and valleys here and there. And it does raise the question on what to do in the here and now with these shares.
Yeah, look, obviously it depends on one's portfolio, whether you're a professional manager or a consumer, because if you've rode that wave, it's probably the majority of your portfolio, and single stock risk is obviously something you want to avoid. Look, I think, Jim makes some very good points about what the right re-rating for Apple is. And that's at the heart of the investor debate because, folks might argue it's a consumer product companies. Some folks would argue, look, there's more obsolescence risk to a technology company like Apple, even with a sticky installed base. Look what happened to BlackBerry. Look what happened to IBM and mainframes. Look what happened to PC companies like Dell and Compaq. There's always obsolescence risk, which is less prevalent in consumer package companies. And so I do think that investors struggle with that because there are some attractive attributes around recurring revenue and the consumer franchise that Jim alludes to. But there's always this looking over your left shoulder around, well, there's pricing pressure in tech. There typically isn't in consumer products, and there's obsolescence risk. Look, for the near term, we think the company's really doing well. There's a very strong buy bid on the shares from Apple itself. We think they may be able to take more price than the street believes next year, and that may mean that numbers ultimately go up. And, generally the stock does very well into new product announcements, and we have a new announcement starting, in early September. So, the near term, it's easy to see why the stock is going up, and I think in the near term, investors should continue to ride that.
Jim, I'm reminded as we talk about, Apple and how it's gotten to this point and the pricing power that they've had to the degree which Toni was just alluding to. I go back to a conversation that I had many years ago with Steve Ballmer, who scoffed, frankly, who laughed at the iPhone at $500 in the initial go-round of when this phone first came out, and here you are north of $1,000. If anybody understands pricing power, it sure as heck seems to be Tim Cook.
Yeah, well, Tim said something very interesting, too, on the conference call, which he talked about, well, what price, someone said, it was a great question, what price will people pay for an Apple? And he said, whatever they think it's worth. And they obviously think it's worth a lot more than we can sell it for. And and they'll pay $1,000. One of the things that is amazing about this thing, though, is it's that customer satisfaction rate and how little that has ever played in the role of a technology company. And Tony's right. I mean, we had to be worried about Dell, Compact. But you know what? We always hated, Mr. Michael Dell's very good, but we never really loved our Dell. We never really loved our Compact. But there's only a couple things in the world that people really pay up for. They'll pay up for Netflix. They'll pay up for Uber. They'll pay up for Amazon Prime. They'll pay up for Apple. And, when you find something like that, it is so rare that we really don't know what to do in terms of how to value it as a stock. And, the most dangerous words, the words that have kept me from making the most money in the stock market is people who say this time is different, is costly. Because it turned out to be very different. It is very difficult to figure out a technology company that ultimately became a consumer product story, because I can't think of any other. It hasn't happened. There is the best performing stock for the last few years has been Domino's, and that's a technology stock that's a pizzeria. I mean, you can say that that's kind of the analog, but it is really hard, guys, to try to figure out what to pay for it. So I just defaulted to traditional analysis and said, okay, what are some of the companies that have tremendous brand loyalty, and what kind of multiple will we pay? And the answer is a substantially higher multiple than you're getting right now.